Trading is not what you see in advertisements or in the glossy, ephemeral success stories flooding your device screens. It is an exhausting psychological battle taking place in the silence of monitors, where the true opponent is not found in market fluctuations, but deep within yourself, constantly testing your consistency. Many come here expecting rapid change or some magical method to unlock price secrets, but they quickly collide with the cold, inert reality of exchange mechanics, where emotions hold no weight. True mastery lies in the ability to accept losses as an inherent part of the process, while preserving your capital for the next high-probability opportunity. Decisions made under the influence of haste or deep frustration lead, without exception, to a systemic imbalance and ultimately the destruction of the trading structure. We are talking about a process that requires almost surgical precision and absolute unwavering discipline, regardless of external noise. Real success is a long-term game of survival, not a pursuit of momentary profit peaks that only drain mental energy. When Niccolò Machiavelli wrote his treatise on the principles of maintaining power, he spoke of the necessity of seeing reality as it is, harsh and devoid of sentiment. The market is a similar structure. We must first understand that the driving force is not candles, indicators, or even news, but the hidden and constant struggle for liquidity. Liquidity is the lifeblood of the market, its vital essence, and it always flows towards areas where the greatest involvement of capital is expected, or conversely, its greatest forced extraction. Understanding the zones where retail stop losses accumulate, or where the open orders of large institutions sit, provides a context that cannot be found in any beginner's textbook. This knowledge allows one to view manipulative moves as part of a natural redistribution process, rather than a personal insult or failure. This is the only way to form realistic expectations of your trading actions and reduce internal psychological friction. Without this understanding, a trader remains merely a pawn reacting to momentary changes rather than the architect of their positions. Trading formula: liquidity equals potential fuel for movement.
Risk is not just a percentage of a deposit. It is a metaphysical category that defines your capacity for longevity in this game and the depth of your mental resilience. The biggest mistake is viewing risk as a one-off transaction rather than a systematic, consistent variable that must be controlled with iron resolve during every interaction with the market. This means your risk per trade should be so small that a series of 10 consecutive losses causes no emotional discomfort or desire to deviate from your plan. Only when you psychologically decouple your emotional state from the financial outcome of a specific trade do you gain the freedom to make objective decisions. Many speak of discipline, but actually practice self-restraint, which inevitably breaks under the pressure of unpredictable moves. True discipline is the ability to follow the plan every single time, even when the market seems entirely irrational. Your capital is a tool that must be protected as the highest value, and every trade should be merely a controlled experiment where losses are predetermined and accepted. If you increase risk after a few wins driven by euphoria, you are signing your own death warrant, as the market always returns the player to the mean, and these large, uncontrolled positions will become your trap. Conversely, reducing risk after a series of losses only confirms your insecurity and fear, preventing you from fully exploiting the next high-probability opportunity. A true professional works with a fixed, immutable risk formula that creates a protective buffer against internal, unmanaged impulses. This applies not only to the amount, but also to the time spent at the monitor, as fatigue and information overload are enemies just as treacherous as large losses. Capital protection is daily, meticulous labor, requiring self-control that surpasses ordinary human reactions to fear or greed. Trading formula: acceptable loss equals constant times ability to recover.
Do you want to know how the world actually works? Forget about soft leadership for a moment. Open the book that defined the very concept of political strategy, Niccolò Machiavelli, The Prince. This is a survival manual for a world where everyone plays for themselves. How to maintain your positions. How to recognize traps before they spring. How to turn chaos into your own tool. This isn't just history, it is the essential foundation for anyone striving for success in the modern era. Discover why a leader must be both a lion and a fox to survive. Link to the book below the video.
Market structures are not static geometric shapes that can simply be identified and traded. They represent dynamic, living ecosystems, constantly adapting to the flow of liquidity and information. Beginners often fixate on small, high-frequency movements, trying to find the perfect entry on a 5-minute chart, while ignoring the context created on weekly or daily timeframes. These higher timeframes determine the true gravity of the market, showing where key support and resistance levels lie, the levels that actually matter to major players. If you attempt to open a long position against a powerful long-term downtrend, you are playing against the wind, and your probability of success decreases significantly, even if technical indicators on a short-term chart look favorable. Structural analysis requires patience and the ability to see not a line, but a zone, a whole area of price where the accumulation or distribution of capital occurs. Understanding structure also means the ability to identify breaks and the maintenance of trends rather than just their visual presence. This requires a constant reassessment of whether current price action truly violates previous highs or lows. Many traders mistakenly identify small pullbacks as full trend reversals, rushing to change their positional bias and exposing themselves to unnecessary risk. We must learn to read the language of candles and volume, which tells us about the intentions of market participants, not just their past actions. This is a skill developed over time, requiring thousands of hours of observation and analysis rather than quick pattern memorization. Realizing that price moves from one liquidity zone to another is our only true guide in this chaos. Trading formula: higher timeframe context equals 80% probability of successful directional choice.
Trade execution is the moment where all your strategic calculations and psychological preparation undergo the final, harshest test. It must be perfect, otherwise all previous work loses its meaning. It is not just pressing a buy or sell button, but a subtle interaction with the broker, the market, and your own order management system, where a millisecond delay can cost you the optimal entry price. Professionals know that the perfect entry point exists only in textbooks, but they strive for the maximum possible precision, minimizing the impact of slippage caused by low liquidity at the moment of execution. This is especially true when trading news or during high volatility, when the market can jump past your desired price, leaving you behind or filling you at a worse rate. Proper execution requires using the appropriate order types, limit orders to ensure a better price and avoid slippage, and market orders only in exceptional situations where speed is critical. You must also account for hidden costs, commissions, spreads, and overnight fees, which may seem insignificant in the short term, but substantially reduce your total profit over distance. If your average profit per trade is only 1R and costs eat up 0.2R, your efficiency drops by 20%. This is a mathematical truth that cannot be ignored. Execution is a mechanical, almost robotic process that requires a total absence of emotion, which is the most difficult task for a human being. Trading formula: net profit equals exit price minus entry price minus commissions plus slippage.
The greatest obstacle to consistent earnings does not lie in the complexity of market structures or the unpredictability of external events, but in the trader's internal desire for self-affirmation, the urge to feel right, which often outweighs financial expediency. When you open a position, a strong desire is born in your mind for that position to confirm your vision of the market. This impulse causes you to hold losing trades too long, hoping for a reversal, or to close profitable trades too early out of fear that the market will turn. This pursuit of psychological comfort is the mortal enemy of objective trading because it forces you to deviate from clear, predefined exit rules. You begin searching the chart for confirmation of what you have already done, ignoring signals that directly contradict your position. To overcome this phenomenon, one must build a strict barrier between their identity and their trades, understanding that a trade is merely a statistical event, not a reflection of your intelligence or worth. Your success is determined by the system, not an individual decision. A strict protocol must be implemented to ensure that the decision to exit or hold is based solely on objective changes in market structure, not on intuition or hope.
Checklist: preventing psychological self-affirmation. Is the stop loss set at a clearly defined structural invalidation point? Yes, no. Has the price changed the key higher structure, requiring a reassessment? Yes, no. Does the hold time exceed the maximum limit defined by the system? Yes, no. Am I feeling strong emotional discomfort signaling over-leveraging? Yes, no. Am I looking at a lower time frame just to find an excuse for a losing trade? Yes, no. Am I ready to accept the loss and immediately begin looking for the next opportunity? Yes, no. Am I sticking to the originally defined target without moving the take profit? Yes, no. Trading formula. Ability to accept loss equals freedom to make decisions.
Imagine the scene. You've opened a short position at a key resistance level after the market showed a clear rejection from a price zone you deemed a distribution area. Your stop loss is set just a few pips above the obvious high of the previous day. The price begins to move in your direction, slowly, almost sluggishly, giving you a sense of control. But minutes later, the market suddenly accelerates against you, breaking not only that high, but triggering your stop loss in seconds. It was a swift, surgical liquidity grab orchestrated by large players. In that moment, as your order is filled at a loss and the initial surge of anger or disappointment grips you, you see the price, without holding that new high for even a minute, sharply reverse and begin to plummet in the direction you originally predicted. This is a classic trap designed solely to sweep the liquidity accumulated behind a key level, knocking out all the early shorters before the real move begins. Your task in this critical moment is not to scream at the monitor or rush into a revenge trade, but to take a deep breath and reassess the situation with a cold mind. If the structure was not truly broken and this breakout was merely a liquidity grab, the market has just provided you with an ideal, though emotionally difficult, re-entry. It takes extraordinary discipline to swallow the loss, admit you were used as liquidity, and immediately reopen the position, perhaps even with a larger size if your risk management allows, as the probability of success has now increased. This demonstrates that trading is a game of patience and the ability to recognize system errors, not personal failures. Trading formula: liquidity grab equals rapid stop-loss extraction followed by the true move.
Developing a trading system is not about finding a holy grail or a secret combination of indicators. It is about creating a consistent, statistically grounded asymmetry where potential profit significantly outweighs potential loss. Your system must be so clearly defined that you could hand it to another person and they would achieve similar results. Any subjectivity becomes a source of chaos and emotional interference. True edge is rarely complex. It often lies in the simple but extremely consistent execution of one or two high-probability strategies that you have practiced to the point of automation and that align perfectly with your psychological profile. If your system doesn't provide clear rules for entry, exit, and position management, it is not a system. It is a collection of hypotheses you are testing with your own money. As Machiavelli taught us, one must have a clear plan of action adapted to changing circumstances, rather than relying on blind faith or unpredictable external forces. Trading requires abandoning the illusion of market control and embracing control over the only thing you can, your own risk and execution. If your strategy has a 1-to-3 reward-to-risk ratio, it means you can be wrong 70% of the time and still be profitable, which significantly lowers psychological pressure. The focus must shift from seeking perfect accuracy, win rate, to maximizing the mathematical expectancy of your overall system. Trading formula: trading edge equals positive mathematical expectancy times consistency. Ultimately, trading is a marathon of solitude and endurance, where constant self-reflection and the ability to adapt are more important than initial capital or intellectual capacity. The market does not tolerate laziness, does not forgive negligence in journaling, and will always punish those who allow themselves to deviate from established risk parameters, even if it only happens once. Keeping a detailed trading journal is not a bureaucratic whim. It is your only objective tool for identifying weaknesses in your system and the psychological triggers that lead to irrational decisions. You must know not only why you won or lost, but how you felt in that moment. Constant analysis of your past trades, especially the losing ones, is the key to self-improvement. The market tends to offer the same psychological traps over and over, testing your memory and resolve. Accepting the fact that losses will always exist, regardless of your system's perfection, frees you from perfectionism,
another insidious enemy of the trader. The process requires creating mental distance from money, viewing it only as a tool for work rather than a source of self-esteem or emotional satisfaction. This emotional neutrality allows you to survive long periods of stagnation or losing streaks without panicking or radically changing what works over the long run. Trading is more about psychological stamina than technical analysis. The part of your brain that craves order and predictability must be disciplined to accept the probabilistic nature of the market. If you're not ready for the daily, routine, and often boring work of self-control, this path is not for you. The market will squeeze you out of its ecosystem with ruthless efficiency. You must cultivate a patience that borders on indifference toward short-term results. This doesn't mean you shouldn't feel emotions, but you must learn not to let those emotions dictate your trading decisions. You must realize that the market is not to blame for your failures, and it is not interested in your success. It simply is. It moves according to the laws of supply and demand, and your task is to correctly interpret its movement and embed your risk into this dynamic process. Your success is defined not by how much money you made this week, but by the consistency with which you followed your system over months and years. That is the only real measure of professionalism. You are a risk manager who occasionally trades, not a gambler seeking thrills, and this shift in identity is the most important step toward financial freedom. Trading formula: long-term result equals constant discipline times statistical edge. Trading, much like the art of governing described by Machiavelli, is the ultimate test of one's ability to remain rational in an irrational environment. It is a path where your greatest victories will never be celebrated by crowds, and your most painful defeats will be suffered in total silence. The market does not care about your needs, your hard work, or your sense of justice. It only recognizes the cold efficiency of those who can align their will with the flow of liquidity. To reach the pinnacle of this craft, you must undergo a complete internal transformation. You must cease to be a seeker of luck and become a cold calculator of probabilities. Real freedom in the markets is not the absence of losses, but the absolute absence of fear toward them. When you no longer seek to be right, but only to be disciplined, the market stops being an enemy and becomes a mirror of your own maturity. Master yourself, and the charts will follow. This is not just a profession, it is the highest form of discipline known to man. Trading formula: self-mastery equals the ultimate competitive advantage.